Hi, Thomas Castelli here, and in today's video, we're going to be breaking down the powerful tax strategies that real estate investors use to reduce and even eliminate taxes on their W-2 and active business income. Does that sound too good to be true? Well, let me break it all down for you. Before we dive right in, if you do like this video, make sure to hit that like button and the subscribe button, as well as the bell icon so you don't miss out on future tax savings tips. First up, let's talk about depreciation. The IRS allows you to depreciate your property over 27 and a half years when you have residential properties and over 39 years if you have commercial properties. And this allows you to reduce your taxable income and even use the losses to offset your W-2 income without a single dollar actually leaving your pocket, because depreciation is a non-cash expense. And it gets even better because you can use tax techniques like cost segregation studies and bonus depreciation for even larger non-cash deductions that can be used to reduce taxes on your W-2 or active business income. Okay, so the first strategy that allows you to use real estate to reduce taxes on your W-2 or active business income is going to be the special loss allowance. If your income is below $100,000, you can deduct up to $25,000 of losses against your W-2 or active business income. Now, if your income is above $100,000, this deduction is reduced $1 for every $2 of income above $100,000 until you have $150,000 of income, where this deduction is completely phased out. So, for example, let's say you had $125,000 of income, your deduction is going to be limited to $12,500. But what if your income is above $150,000 and this deduction is completely eliminated? Well, at that point, you're going to want to consider the second strategy, which is qualifying as a real estate professional, also known as reps. And the real estate professional status isn't just for full-time agents and brokers. If you or your spouse spend more than 750 hours and more than half your total working time managing your rental properties, then you can take the losses from your rental properties against your W-2 or active business income without these income limitations that you have with the special loss allowance. But what if your income is above $150,000 and you can't work full-time in real estate and qualify for the real estate professional status? What do you do then? Well, the good news is there's another strategy you can use called the short-term rental loophole. So if you have a short-term rental property, such as one you might find on Airbnb or VRBO, and it has an average stay of 7 days or less, you do not need to qualify as a real estate professional to take the losses. All you need to do is materially participate in your short-term rental by basically managing the property, and the most popular way to do that is by spending more than 100 hours on the property and making sure that nobody else spends more time than you working on the property. And the good news here is that for you and your spouse, both your time counts as one person. So between you and your spouse, you spend more than 100 hours managing the property and making sure that nobody besides you two spends more time than you will have met this test. And it's a very popular strategy for people who have a full-time W-2 job, or perhaps a full-time business that they're operating and cannot qualify as a real estate professional, and if their income is over $150,000. So these are just a few strategies that savvy real estate investors use to reduce and even eliminate taxes on their W-2 and active business income. And remember, it's all about playing smart with the tax code. If you found this video helpful, make sure to hit that like button as well as the subscribe button and the bell icon so you don't miss out on future tax savings videos. And if you do have any questions about any of these strategies, go ahead and drop them in the comments below. We're going to answer as many questions as we can to help out as many people as possible, and we'll see you in the next video.